This is a chart of Newmont Mining, a really large mining company going all the way back to 1970. You can see the bull market. It didn't participate as much as it probably should have. There was the 1980 peak right in there. Had that big correction. Then remember we had that nice rally in 1982, and then down it went. Had a pretty good rally here. Here's the thing that I'm trying to highlight. You know, I'm always talking about trend lines. We have a trend line here that goes all the way back to 1970, maybe the middle of 77, and just follow the mouse across there. Newmont actually hit that trend line going all the way back, so that's 70, 87, 90, 21 years long. And who would have ever thought that it would happen? But it did it so many times. No matter how high it went, it always came back and it touched the trend line. And I think it got down to maybe around $20, $50, $21 in that range. So that's pretty remarkable. Here's a quick chart going back to 1960 all the way up until about 2005 on silver. Gold's chart looks very similar. You can see here we had the initial big run-up until the mid-70s, what would that be? I guess 1974 was the top. We had that mid-cycle correction that we're just finishing now in this bull market cycle. And then it kind of went along for a couple of years, and you can see the parabolic bowl, and then kaboom, it just literally went crazy. This is what we are coming up to in the next wave. Wave 3 is just going to be a gigantic wave. You do not want to be in a hurry to do any selling. You want to be able to draw as many charts as you can. Keep drawing trend lines, and you'll be able to stay in the rally as long as possible. It's going to be phenomenal gains. Here's the Barron's Gold Mining Index going back to 1966. We don't care about that crap. What we do care about is here, here, and here, because these patterns are replicating themselves in the current bull market cycle. And you can see here that you had a gain in the sort of mid-72 to 1974. That would be roughly 350%, 75% correction. And then you had 650%, you can see, in up to 1980 when it finally broke out. A very quick 2-year correction. I think it was like 75, 77% decline, then another 300%. So roughly, let's just say 300, 600, and 300, all within like 7 or 8 years. So 3 and 6 is 9, and 3 is 12. 1,000 becomes 12. 100 becomes 1.2 million from 100,000. Just do the math. These cycles are repeating themselves. Pretty close proximity between the Barron's Index and the USERX, both because they're based on precious metals. This is a really good visual on the XAU gold going all the way back to 1985. This was the high extreme up here in the 37.50, 38 range, and I suspect we're going back there. 1, 2, 3, 4, 5 times over 22 years this level of support held. A minor break right there. That was in the maybe 16 range, and that's where you take the XAU, divide by the price of gold. When this chart is at the bottom, that means that the stocks are very cheap. When it's at the top, it means the stocks are very expensive. You should sell them and buy them here. We reached under 10, I think somewhere around 9.7, which is like the cheapest that I have ever seen, the gold stocks compared to the metal. Quick little chart here going back to 1972 on the price of gold, how it evolved in the bull market in the 1970s. Started out around 35 bucks. 1972, it's still sitting in the $60 range, and you can see the up waves here. You know, 1, 2, 3, 4, 5 waves up, and then we had that 2-year correction where it went from just about 200 all the way down to 100. Even in 1979, remember gold topped out in early 1980. In mid-1979, it's still sitting in the $240 range. And then literally within 10 months, it went from $240 all the way to $850. And I don't know what the closing price was, but that was the intraday. So you can see at the end, the parabolic fashion that it'll go up. Again, you can see the trend line here. You stayed in the rally the entire time. As long as you don't violate that trend line there, then you know that you're okay. That tends to be in a 45-degree angle. Now what happens eventually when it gets parabolic, it goes 50, 60, and then literally it just goes like straight up. And when it violates the first trend line, then you know that you've had a lot of fun because you were smart enough to be buying down here. Then you know you sell and you bank your profits. This is a really good chart because it shows the evolving gold price stuck at 35 bucks, you know, because of government requirement. It wasn't until 1971 when Nixon let the price of gold float. What that really meant was that the US dollars were no longer going to be backed by gold. And the demise of the US currency was predicted at that point in time, because when you go off the gold standard, even though it took 30, 40 years, no currency in history has ever survived. And that's called a fiat currency, F-I-A-T, and here we are again in 2008, and the death of the US currency is just a matter of time. I mean, they could eventually back it by gold again. They could issue a new currency, but then the price of gold would probably be $5,000 or $10,000 an ounce. Here you can see the, and where I'm moving the mouse around here, this is the mid-1970s correction, and then just look at that parabolic upshoot to just over 8, maybe 830, 840, whatever the price was. I think it actually got to 850. And then we went through that long bear market. Here's the channel that it traded in. Bottomed at 250. Now you've got a trend line, and you can see that we've gone up higher than that already. Where do we go? Inflation adjusted is somewhere around 2,200. So we have a tremendous way to go. We're down around this level right now. It actually got to maybe 685, something like that. Maybe 690, and this is now October 29th, 2008. Just a quick comment here. You could have a major index like the Dow Jones, the S&P, the NASDAQ, triple Qs. This is the HUI. This is the major downtrend line from the 520 high, and you can see the angle of this downtrend line. This is going to be important later, and of course you have to redraw the chart, and the angle of the line will change a little bit depending on how long you're drawing the trend line for. But the point I'm trying to make is still the same. When you draw that major downtrend line, to be in a confirmed bull market, the prices will have to get above that trend line by 5%. Generally what happens is they'll break above, come back, they'll touch it to test it, and the idea is if there's enough buyers there, more than the sellers, then it'll skyrocket forward, and that will let you know that you're now in a confirmed bull market upcycle, and then the gains will accelerate quite a bit after that. It's kind of silly to wait for that, because that right now is showing the 450 level. Well, prices got to 150, so like, hello, do you want to buy a house for 100, or do you want to wait until it passes the $300,000 range? So, you know, it all depends on the mentality of the investor and what their time frame is. But I'm referring to institutional buying. They're not looking to buy the bottom, and they're not looking to sell on the exact top, so they may buy later, sell sooner, and make their profit in the interim, in the middle, where the leg has got some validity to it. It's gotten ahead of its major trend lines. You're going to get a major buy signal, which is like a golden cross, where the 50-day moving average will cross above the 200-day average. So they don't worry too much about the bottom. They might sell, even not at the exact top, but they may even sell before they get to the top. So they're kind of making their money in the middle.